Good morning and welcome to Charting the Markets on Wednesday, the 10th of January 2024. Now, overnight, Asian markets were quite mixed, except for the Nikkei 225, which rallied to a 34-year high on a weaker yen on expectations that the Bank of Japan will keep its very loose monetary policy for longer. Now, what we also saw this morning is that European equity markets tried to regain some lost ground, having come off yesterday after Monday's very strong gains, which in the US, for example, were the strongest seen in about 2 months. And you can see that here on the daily chart of the FTSE 100 daily financial bet. We came off earlier this morning after yesterday's falls and are trying to stabilize now in this market, despite the Eurozone facing recession risk potentially. We just had comments out from Luis de Guindos from the ECB, who said that there was a slowdown in the third quarter growth in the Eurozone and also a contraction in December. And the European markets on that news were slightly lower, together with the FTSE 100, as you can see here, but then recovered, which has really happened for the FTSE 100 yet. So here we are just trading sideways ahead of Friday's GDP data out for the United Kingdom, and also more importantly ahead of Thursday's US CPI reading, so the inflation data for the US coming out on Thursday. So market participants are basically waiting for that to give us an indication of what the next direction with regards to equity markets will be. Now, with regards to the FTSE 100, basically, as long as we stay above Monday's low at 7,635, further upside it is in store, and we could actually retest the high seen back in October at 7,702, provided we stay above 7,635. And if we were to fall through 7,635, though, the next downside target would be the red line here, the 200-day simple moving average at 7,576, which is a potential support level. Now, I just mentioned the Nikkei 225, and as you can see here, we accelerated higher very sharply on the back of several days of high rising prices. Now, don't forget, this is the daily financial bets that you can trade on the IG platform, and therefore you had trading going on whilst the Japanese markets were actually shut for holidays at the beginning of this year. But basically they are back in earnest now this week, and as you can see here with a very sharp acceleration, take us to levels last traded back in January of 1999. As you can see here, this is a quarterly chart, so each of these candles represents 1 quarter of data. And the Nikkei 225 is now heading towards the psychological 35,000 mark, as you can see here. And that is just below the December 1989 high at 38,957, which is a long-term upside target for the Nikkei 225. So the Nikkei really outperforming here. As you can see, we've broken through some key resistance that we've had in place since June of last year, and in doing so probably triggered a lot of stops and a lot of buying, which took the Nikkei 225 earlier this morning to a 34-year high. Now, looking at US markets, what is interesting when you look at the S&P 500, for example, is that the whole of last week we came off. We had basically more or less 4 to 5 straight days of weakness, take us down to 4,664 on this daily financial bet here, which was a 2.5-week low, before then rallying in line with the Nasdaq 100, basically on tech stocks rising. The Nasdaq had a nice rally on Monday, and you can see that here it was replicated by the S&P 500, which had its strongest day in about the last 2 months. But that was then followed by pretty much indecision here yesterday on Tuesday. And today on Wednesday, you can see in the open trading on the IG platform ahead of the official open this afternoon, not much is going on here either. Now, for the uptrend to continue, what we need to do is to rise above Monday's highs at 4,765. If that were to happen, and if we could also take out the December 20th high at 4,778, then I expect the high seen in December at 4,795 to be reached once again. So upside pressure remains in play for the S&P 500, provided we stay above the low we saw Friday of last week at 4,664. The US dollar regained some of its recent losses over the last couple of days, but hasn't really moved that much. And you can see the impact of that on the euro. As you can see here on the daily financial bet of euro dollar, we sort of came off a bit over the last few days and then tried to rise again. But yesterday we came off on that stronger dollar I just mentioned, but today that is being negated by the currency pair heading back up again. And really not much happening here. As you can see, everyone's waiting for the inflation data out of the US tomorrow. And until we have that data, I wouldn't be surprised if volatility stays really low. As you can see here, we have got really small candles forming, showing us that there isn't really much volatility in the euro-dollar currency pair at the moment. Now, from a technical perspective, the uptrend we've had since October of last year remains in play. As you can see here, we remain above the uptrend line. And basically, if we were to rise above the high seen last Friday at 109.98, then we could basically retest the highs going back to November and also mid-December of last year at 110.17 to 09 to 17, I should be saying. So those are key resistance areas that we are focused on if we were to manage to rise above 109.98 on Friday. And on the flip side of this, if we were to instead fall through this October to January uptrend line and also last Friday's low at 108.77, we would most likely retest the orange line here and the red line, which are the 55 and the 200-day simply moving averages between 108.60 and 108.49. And below that, we also have a potential downside target between the 6th of November high at 107.56 and the December low at 107.24. But right now, we're just trading sideways, and those breakout points I just mentioned, 108.77 on the downside and 109.98 on the upside, will be probably defining where we're going to head next. So a breakout of those of that recent trading range, if it is bullish, will probably lead to higher euro-dollar levels, and if it is bearish and goes through 108.77, will probably lead to a further decline in the currency pair. Now, moving on to Japan. Japan is really interesting because basically what we've seen here over the last few days is first of all, Japanese markets coming back in earnest, people coming back from holidays, and then also the fact that market participants now expect the Bank of Japan to maintain its ultra loose monetary policy for longer, and that has led to yen weakness. And as you can see here, the US dollar against the Japanese yen rising again and heading back up very gradually, though, towards Friday's high at 145 yen and 98 cents. So that's the next upside target for this currency pair, provided we stay above the last reaction low. And what is a reaction low? It's simply a low on the daily candlestick chart, which is lower than the one to its left and to its right. And you can see that was made yesterday on Tuesday at 143.42, which incidentally was exactly at the 200-day simply moving average, which acted as support here in red. So basically, as long as we stay above 143.42, the last reaction low, further upside is in store. If we were to take out 145.98, the high seen last week, we could then head towards the orange line here, the 55-day simple moving average at 146.60, and perhaps also retest the October low at 147.28. So these are the upside targets for the currency pair, provided we stay above the 200-day simple moving average and yesterday's low at 143.42. Now, another currency pair that is interesting at the moment is the US dollar against the Canadian dollar. And as you can see here, we had a rise in the US dollar against the Canadian dollar from the late December lows. And that rise took us to the November to January downtrend line, which we were trying to overcome yesterday, but didn't manage to do so. We managed to do so on an intraday basis, but not on a daily chart closing basis. And this morning, we are struggling around that resistance line at the moment. Now, if we were to manage to break through that resistance line, and if we were to rise above yesterday's high at at 134.15, we could then engage the early December low at 134.87, and also the red line here, the 200-day simply moving average at 134.80. So these are potential upside targets, and those will remain in play provided we stay above the low seen on Friday at 132.88 down here, because again, that's the last reaction low. I know there is a small one yesterday, but because it's so close to the previous day's lows, I think it is less important from a technical perspective than this big volatility day we saw last Friday. So here we are trying to grapple with this downtrend line and trying to break through it. If successful, we could be heading slightly higher towards the 135 area with regards to the US dollar against the Canadian dollar. The oil price has been quite volatile of late, rising by over 6% and then falling again. And you could see that on this WTI chart. And you can see here we had a very sharp fall on Monday as Saudi Arabia announced that it would be cutting its prices for its oil to exports in Asia. And that has led to a 6% decline in the oil price. And then we had a nice bounce back from that low earlier this week, yesterday, amid heightened tensions in the Middle East. And also as Libya continues to not produce any oil at its Shahrara oil field, because last week there were some protests around the oil field, and basically that has led to about 300,000 barrels per day not being put onto the market, and has led basically to supply worries pushing the oil price higher, as you can see here. But interestingly enough, we are now in a very interesting technical position, because we've got on the one hand the September to January downtrend line, which acted as resistance last week and earlier this week, and today comes in around 73.44. And on the other hand, we've got the support line going back to the December low, which currently can be seen around 69.76 on this futures contract. And basically, you can see here we're trading in a sideways trading range, the breakout of which will probably determine where we're going to head next with regards to the oil price. So from a technical perspective, a break through this September to January downtrend line, and more importantly, last week's high on Friday at 74.26, would most likely take us back not just to the late December high at 76.20, but also towards the 200-day simply moving average here at 77.66, and slightly above there towards the mid-November and late November highs between 79.62 and 66. So these are upside targets for crude oil if we were to manage to rise above last week's high at 74.26. Now, the flip side of that is that we could also fall through the low seen on Monday of this week. And if that were to happen, if we were to fall through the low on Monday at 70.21, and also this uptrend line going back to the December low at around 69.86, then most likely we would slide all the way back down again towards that December low at 67.94. But basically, we have to wait for the breakout. It could be either way. And you can see here, we're just trading sideways. Volatility is picking up. So it's quite likely that over the next few days, we will see a breakout of that trading range. And maybe today's EIA data with regards to crude oil stockpiles and inventories could give us that impetus either to the upside or to the downside. Another commodity I'd like to look at today is corn, and you can look. You can see here on daily corn futures. These are now trading in 3-year lows. If I zoom out and go onto a weekly chart, you can see that on the chart we are now trading at levels last seen back in December of 2020, and we're clearly in a downward trend here, and are likely to slide further within this downward trend. So the corn price has fallen through some really key support going back to all the lows seen since August of last year, below 471 on the futures contract. And basically, as long as we stay below that key resistance area and also the high seen on the 4th of January at 474, further downside is likely in store. And that could take us not just towards the 450 mark, but probably quite a bit lower still from a medium to long-term perspective. And last but not least, I'd like to mention New York orange juice futures contracts. And as you can see here, we're coming off last year's all-time record highs, which were made above the $400 mark, as you can see here on the futures contract, 419.22 on the daily financial bet. And since then, since the 21st of November all-time record high, we've been trading in this very clearly defined downward trending channel. And interestingly enough, yesterday fell through the red line here, the 200-day simple moving average at 312.10. So that, to me, says that the downtrend is very clearly in place and is likely to continue as orange juice supplies are picking up and production is picking up. And you can see here the next downside target is the 287.24 low going back to August of last year. And below there, we have some downside targets slightly further down towards the July high, the early July high around 271.20. So further upside most likely in store with regards to orange juice futures prices. And this downtrend from a medium-term perspective should remain in play as long as we stay below the current January highs at 339.43. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG.